Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? I know you have heard me say it time and time again, but the more that you use the policy, the larger these values are going to become inside of your policy. And today, I'm going to mathematically prove that, and we are going to go back to the basics of becoming your own banker. And we're going to be walking through the equipment financing example today. It's very powerful. I actually spent this weekend, I went over to Universal Studios in Orlando. And I was going through the haunted houses at the Halloween Horror Nights. So that was a lot of fun. Hopefully, everyone had a wonderful Halloween. I know as this episode launches, it's going to be mid-November sometime now, and now we're kind of getting ready for the Thanksgiving hour and family coming into town, and or us traveling to go see family. So it's an interesting time of year, you can say so. So I know it's a grateful and blessed time, and I know that things start to slow down as well during this time of year. So I encourage you, as we are slowing down into the end of the year, go back and spend some time really studying, study becoming your own banker. Go out there, listen to the podcast, keep you hitting the gym as you promised yourself at the beginning months of 2024. So stay consistent, stay up to date. And that's why I just wanted to take it back to the basics of the equipment financing example on page 51 of becoming your own banker. And yes, if you are listening to this auditory right now, it may be a good idea to hop over to the YouTube, just type in the Money Multiplier podcast. And I'm going to be showing some stuff on my screen so that we can walk through this together. Because for my folks who don't have becoming your own banker, first of all, naughty on you. Second of all, you can go to Amazon or our website, themoneymultiplier.com, purchase the book from there. But as I always say too, I'm not in the book selling business. I just want you to know where this information is coming from. And what better source to, be out here educating on this concept and going back to the Bible of the infinite banking concept. So, a few things as well. Actually, just this past weekend, we launched the first save the date for our March event that's coming up in 2025. So, Larry Steinhaus and myself, we're going to be co-hosting Mastering the Money Game. So, live event, 2-day event in Tampa, Florida. So for all of my snowbirds who want to come and hang out with me in the winter months, come out to Tampa and we're going to hang out for a little bit. So if you go to moneygamelive.com, you can go and register so you'll be the first to know that when the tickets get launched. You can go to the registration page. So my first announcement there. Also, every Saturday, let me shout this out as a free resource for y'all. If you go to Piece of a Good Life, so Peace, Piece, pieceofagoodlife.com, you can go and register for Larry's weekly Saturday webinars that he does. Again, they're free. I was just on this past Saturday. I'll probably be on again at one of these upcoming Saturdays too. But another great resource just to dive in deeper and keep furthering your education when it comes to your money and your money language, honey. So, all right. So that event's coming up. What else is on the books? I mean, actually, I'm going to be going out here to Mexico at the time of this episode launches. I'm going to be laying my butt in Acapulco, Mexico. I'm going to go out there for another mastermind event with Clint Arthur, who y'all just got introduced to not too long ago, about 2 weeks ago. You got to meet one of my mentors, Clint, it's just been a transformational experience for myself, really understanding the game when it comes to marketing and being a celebrity entrepreneur. So just something that's really cool. No matter how old you are, I think everybody is starting at a good time where they are meant to be started at. That, yep, grammar, Hannah. Yep, that was great. But don't compare yourself to others. That's a big thing that I've really been working on this year is don't try to compare myself to other people. You are unique. You have a special talent. How you communicate, how you express yourself is so much different than other people. And I think that's a very powerful trait that each of us individually can hold, that characteristic that separates us from other people. So, one thing though that separates us from other people is how we conduct the banking function in our life. And if you can just take back the control of the banking function, you've already outbeat 95% of the population. So, because everything that you do in the financial world is being compared to what everybody else is doing. So I want to get in here, especially for my analyticals who love numbers. This is definitely an episode for you. And I want to get into the weeds of, hey, if I keep sticking to this and I'm playing honest banker, I don't steal the peas, I'm setting up loan repayments, I don't be afraid to capitalize my banking system. Okay, grammar is not my favorite thing today, but you get what I'm saying. Don't be afraid to keep capitalizing your banking system, have a place to warehouse your windfalls, and keep rethinking your thinking. This is the power of what you can do with these policies. So let's get into it. So students, what we're going to first do is open up our books to page 51, where Nelson gets into the equipment financing. And I just want to read a few verbiages or passages from this section too. Now that we have established the fact that a dividend-paying life insurance policy has all the characteristics of a banking system, because first of all, one thing that Nelson does state in this book, which I kind of agree with him on, is that, the insurance company should have never have titled this a whole life insurance policy, because in all reality, it's more built as a personal monetary banking system. But that doesn't sound so sexy and attractive when you try to put it out there and solicit it to the consumers, the American general public, because then they got to go through a lot of the paradigm shifts and curves over here. So, that it is a benefit though. We got the death benefit that's on the policy, but really a whole life policy contract does have all the characteristics of a banking system. We have the hired help, which is the insurance company. We have the lawyers, the people who put together the contract and all of the legal crap that has to go behind it. But then you got us as well. We are the policy owners. We share in the profits of our hired help, because this is a mutually owned insurance company. And, they work off of salaries. I'm going to get into that here in today's episode. But, because we are the owners of the contract, we are the ones that are always sharing in the profits of that company. And so the insurance company is simply just the people who administer these policies. And then that's how we're able to enjoy the benefits that come from it. But all of this has to work because you and how you behave with your banking system, i.e. your whole life insurance policy. Because let's just be real, you could be the type of person, you could just set it and forget it. But as Nelson Nash does say too, use it or lose it. So I want you to use this because you got to finance every single thing that you buy. So let's refresh your memory of the steps it takes to get into the banking business and then use the system to enhance the things that you are already doing within your regular line of business. All you have to do is select an appropriate plan of life insurance with a dividend-paying life insurance company. You will have to have administrative hired help, and you must put some money into it. So first step, if you don't know where to go to get one of these policies, you can call me, you call your money mentor over at the Money Multiplier, or go out to infinitebanking.org and you can go and find a practitioner who is certified through the Nelson Nash Institute who can help you with this. My biggest advice, work with somebody that practices what they preach and work with somebody that is affiliated with the Nelson Nash Institute. So you must build the capitalization phase. So, you can't start a business or start a bank without putting money into it. So we got to build the capital and capitalize our banking system. And what that is, that's premiums that we're putting into the policy. You get to decide how much you want to put into your policy. You get to choose the premium, and you get to also choose how frequently do you want to deposit in? Is it monthly, quarterly, twice a year, annually? And you can always even bounce back and forth between those different modes of premium. If right now it makes more sense to pay annual, but then next year, because of cash flow reasons, you need to pay monthly, you can do that. You can bounce back and forth with different modes of premium. So we first got to capitalize it. And you may find it necessary to accumulate the capital over a longer period of time. Indeed, additional capital makes the system more profitable. Whoever heard of a grocer complaining about having to fill the shelves on 5 gondolas in his store instead of 4? He knows full well that the additional merchandise will improve his profitability. Neither should someone complain about additional capital or premiums paid into a life insurance policy. This is your banking business. You need to put money into the business in order to have more and more profits. So, have you ever made too many deposits into your bank account? I hope the answer is no. So, that is all that this is. We are just making deposits into our bank rather than making our deposits into somebody else's bank, the commercial banks of America. So that's our first step is we got to put these dollars into it. Now, here's our example that Nelson lays out to us. Suppose that there's this 30-year-old man who is in the logging business and adopts such a plan and puts 40,000 of capital per year into his banking system for 4 years. Now, I'm going to pull up my screen here, and I want you all to follow along with me if you are looking at the YouTube. And we're going to go into this first example here. This policy that he is using is a life paid up at age 65 with a premium of $15,000 per year and a paid up insurance rider premium of $25,000 a year. So a total of $40,000 is going into this policy. As you know, right, there's 2 moving parts that make up the premium. We got the base premium and then we got the paid up addition premium. So both of those come together and that's how we come to the conclusion of the $40,000 a year. Now you'll notice this is what we call the Nelson-Nash design, the 40-60 split. So 40% is going to the base and then 60% is going towards our paid up addition premium. So he's putting that premium in for the next 4 years. Notice that at the end of the first 4 years, the total cash value is $157,363. His accumulative outlay is $160,000. So by year 4, he's almost hitting that break-even point of the cash on cash in that year, or excuse me, the cumulative cash on cash, meaning that I put in $160,000 into this policy thus far, and my cash value sitting here at year 4 is $157. All right, close enough for government work. Next year, definitely, we're at $167,000, as you can see, as cash value that's sitting inside of the policy. You'll notice he doesn't pay any more premiums as well. If I'm a good coach, you will quickly understand that you want to pay these premiums for as long as you can and as much as you can. Let's reread from Nelson-Nash right here, page 51. Neither should complain about additional capital paid into a life insurance policy. Additional capital makes the system even more profitable. All right, let's move on. So we have put in $160,000 up to this point. Beginning the 5th year, no further premiums are required because the current dividend plus surrender of some of his paid up insurance will pay the base premium of the $15,000 from that point on. So what Nelson is actually doing is he's not taking out any loans. He's literally surrendering part of his paid up addition cash value along with his dividend, and that's what he's using to pay his base premium in the policy. I wouldn't recommend that. You can do it, absolutely, but I wouldn't recommend it because if you keep capitalizing this thing, the greater the values will become. So let's move on. So I'm going to show you that. Notice the death benefit at the end of the 4th year is $1.6 million and compare it to the 5th year. which is 1,651,000. So yeah, we notice that there's a slight difference here from the death benefit in year 4 compared to the death benefit in year 5. And the reason being is because we're surrendering part of the dividend and thus that death benefit. Now, in this illustration, this is him just using this and not financing anything in his life. So here's what I want you to get. If we go down to age 65 in this policy, we notice that we have a $1.5 million of cash value that's inside of here. And what we can do is we can start taking out tax-free income from the policy. So beginning in year 37, when this person is age 66, they start taking out $92,000 a year as cash flow from this policy, and they're using it to live off of now. So at the end of it all, let's just make believe that this person were to graduate or pass away at the age of 84. They would have taken out over 1.5 million in tax-free income. Let's put a little asterisk there because I'm going to come back and make some points here. But they also have a 2.4 million death benefit that's going to get paid out to their beneficiaries when this time happens and they do pass away. So you can see at the end of this all, he's paid $160,000 into this policy as out-of-pocket money. Yeah, he's been using the dividends and surrendering part of it to then pay for the base premium. But even just putting $160,000 into this, not touching it, and then just using it for retirement income, he was able to withdraw out because in these examples, Nelson is using withdrawals here in this specific example. And so he's taken out the $1,588,000 and he's only put in $160,000. And this is all done on a guaranteed tax-free basis. Now, yes, let me come back to my asterisk there. The only time a taxable event can occur inside of a whole life policy is when you are surrendering over your cost basis. Meaning, if I put in $160,000 of outside money into this thing and I withdrew over my cost basis, 160,000, then I would get taxed on the more monies that I've taken out than what I put in my cost basis here. But dividends are not taxable. Because a dividend in a life insurance contract is different than a dividend that you may receive, let's say if you are playing in the stock market. Dividends on a life insurance contract in textbook quotes is a return of premium. So what that means is that the insurance company, their profits for that year turned out as expected or better. So they return those profits back to their policy holders in that form of a dividend for the overpayment of the premium. Now, I kind of said that, and some of you Dave Ramsey fans will say, well, yeah, well, that's why whole life insurance is way too damn expensive. No, they're doing this because they want to protect you as the policy holder and the company to keep remaining more and more profitable. Because at the end of the day, this is a life insurance company. They got to make sure that they're keeping up their end of the deals of their contractual promises that they are making to their policy holders. So they're doing this because they want to hold some of those funds back so that in the event they need the monies for when a death claim does have to get paid out, because this is permanent life insurance. And when it happens, notice how I say when, not if it happens, but when it happens, then the company is going to need those funds on hand to then go and pay out that death claim. So there was no taxable event that happened here because he was withdrawing the dividends and the paid up additions cash value that was being purchased by those dividends too. So he could have, I mean, if he wanted to take more, like his retirement income, he could have totally taken more, but he didn't. He just took out what he needed, what was necessary, which is the 92,000 a year. And this is a quick reminder too, that you should know what is necessary. You should know how much you need on a monthly and annual basis to live a good, fulfilled life, right? A lot of people just keep grinding and working away and don't see any end near in sight because they keep wanting to have more, more, more. So go back and reread Parkinson's Law in Nelson Nash's book too, and you'll get what I'm referencing. Now, let's get into the second part here because this gentleman, he comes to the realization that, all right, this above scenario is pretty good, but then it dawns on the young man that I'm paying $16,000 per month to that pool of money for the equipment used in my logging business. The finance company is borrowing the money they lend me from life insurance companies, adding a surcharge to it, and then retailing it to me. I mean, think about it. That's literally what these commercial banks are doing. They're taking money from the Fed at cheap rates, and then they're lending it out to us. And they're also taking our money, we the depositors, when we leave our money there, they also take that money, and then they go and lend it out to us or to other people, and they're putting a premium price on it. That's how they make their money. So no matter how you look at it, there's got to be some pool of money and funds accumulated somewhere. So, and then Nelson kind of makes a joke, because if you go back to like the grocery store example, it's the equivalent of my wife shopping for groceries at Winn-Dixie when we already own a grocery store. How effing rude. So, can I finance a logging truck from my cash values? Of course he can. And he outranks all possible borrowers in access to the pool of money because inside of your policy contract, you, the policy owner, you hold first rights to any cash value that's inside of your policy. So that's why the insurance company can never deny you a loan when you want to take out that money and use it for whatever purpose. And you'll notice they don't even ask you what you're using the money for. They just know that, yeah, you're the owner of the contract. You hold first rights to any of the cash value in here. So now this young man, he's saying, okay, I am going to then use my policy cash values and I'm going to finance this truck. And what he did is he is going to mimic exactly what he has been doing with this company, Peterbilt, who he finances his trucks with. So this man, he paid $65,790 for the truck. What he did is he took 13,000 of it, and that was his down payment. To be exact, it was 13,190. And then what he did is he financed $52,600 for 4 years. So he was taking the 52,600 and he was paying it out to the financing company over the 4 years to finance it. This required him to have an amortized monthly payment of $1,502 per month. But if you calculate this all out, at the end of the 4 years, he paid 72,000 in some change. So he financed 52,000 of it, and a little over a third went to just interest payments alone. So if he spent out a total of $72,000 and he only took out a loan of 52,000, that's over $19,000 that just went to interest alone. Go back to my the podcast episode. It was right before the Clint Arthur episode. And I was talking about how would you rather keep this money or pay to a finance company this money? And in this scenario here, he was paying out almost $20,000 to a finance company just because he did not have the pool of money accumulated for himself. And that's what you got to do. Rule number one is you got to capitalize your banking system first. Be disciplined with your money. So if you divide the interest paid out by the total payments, it will tell you which part of each payment went to interest alone. And it was 27 cents of every payment that just went to the interest alone that he was paying to the finance company. So, what happens at the end of the 4 years? Well, my truck is going to run out. My odometer is at 400,000 miles, and I'm going to need to trade in this truck and get some money back for it, and I'm going to need a new truck. And this time, the dealer may allow him to trade in the value of it, something like $18,000. But the price of the new truck has gone up, and he needs to keep financing the $52,600 on every truck that he buys. But that's him just looking at it for years. His accountant would tell him, but look how you are buying the equity in your equipment. That's true. He's building the equity in the wrong place. He should be building equity in his banking business that finances his truck. So I just want to point out this part here because it is a very impactful moment when your financial advisor is saying, well, hey, look how good you're doing over here. Yeah, you went and financed this truck, but look at all the equity that you built up into it. It's almost like your financial advisor telling you that, hey, well, go over here, put your money into the stock market, just set it and forget it. And then in the future, you're going to be a millionaire and it's not going to matter you having to pay all the taxes on that money because you're not going to be making as much money later on down the road. I mean, it's just bollocks me how sometimes these people think when it comes to your money. Again, we're just not taught about money. You need to master the money game. So again, you need to be there for my March 1st and 2nd event in Tampa, Florida, where we're going to master the money game. But let's move on because this is a very enlightening part. Everybody should be in two businesses in their lifetime. The first business is the one that you're passionate about, supports your family, supports the income, gets you up out of bed every single day. The second business is the banking business, the business that finances everything throughout your life. Of the two businesses, the banking business is the most important because businesses, they can come and go, but the banking business can never go away. So now when he goes in, he's going to buy his trucks this time. He's not going to use the finance company. He's going to call his gophers at the life insurance company. That's how Nelson Nash refers to them, the hired help at the life insurance company. And he's going to ask, can I borrow $52,600 for my policy? The insurance customer service rep on the phone is going to say, oh, yes, sir, absolutely. Would you like this sent to you in a form of a paper check, or would you like me to directly deposit it into your bank account that you have up here on file with us? He's going to say, I would like you to directly deposit it into my bank account. And the customer service rep on the other line is going to go, okay, sir, we're going to send that out and you're going to be seeing it anywhere from 3 to 7 business days. Boop, boop, boop. And then they hangs up the phone. So that's how the conversation literally goes. Then we're going to blow this up, all right? Back here, blowing up on illustration number 2. We are going to finance one truck using this same policy. Nothing has changed here. We're still going to put in our $40,000 a year over the next 4 years, and then we're going to use a portion of the dividends and our paid up addition cash value to then fund the ongoing year premiums. But again, if you use out-of-pocket money, the stronger these values are going to become. So what he's going to do is of his $157,000 of cash value that he has in the policy at year 4, he's going to take out $52,600 and he's going to go and finance this truck. Walks down, purchases the truck, they hand him the truck, everybody walks away. Transaction's done, as what I like to say. Now, pay close attention to this part. It is vital that you understand that he must set up a loan repayment plan that equals or exceeds what he would have had to pay the finance company that he was using in the past. Pay yourself back and pay yourself interest. Treat your money just how you treat the banker's money. His life insurance agent should coach him that at this point, the policy loan interest rate is 8%. But we are not going to play that game. We are going to call the finance company you were using and ask them what you would have to pay if you financed it with them. Work smarter, not harder. This is what I did for my Bronco, y'all. I was literally sitting down there at the Ford dealership and I said, hey, if I were to take out this, I think it was like 6.5% loan with y'all, how much would my monthly payment have to be? He told me what my monthly payment is, and that's how much I pay back myself into my policy every single month. Plus, I actually even pay back a little bit extra if my policy will hold it. I'll put more paid up edition premium inside of that thing. Well, this is what you're going to have to pay. Of course, the policy owner can tell him to get lost. I'm not going to pay any interest at all. This is my money. Why would I pay interest on my money? Here's another big lesson that we don't probably have time to get into right now, but economic value added, EVA, baby. You need to treat your money with the same respect that you treat other people's money. Don't just treat your money like it's free money. Because if you ever forget about that, go back to the Midland Bank of Texas example and see how that bank went belly up because all of the non-performing loans were coming from the head executives and head honchos of that branch bank. And they went belly up because they were not treating their money how they should be treating their money. Pay yourself back, charge yourself interest. Money flows and grows to where it's respected. In either of the foregoing responses, you need to understand the Bank of Midland, Texas story, and then also we need to go back and re-educate ourselves on the grocery store example of don't steal the peas. But if the agent is really good at his job, he will convince him to pay $1,600 per month. That's about 15% in interest payments that he's paying back to himself. So if he pays back the $1,600 a month, that comes out to $18,000 a year that he is then paying back to himself in the policy. I'm sorry, I said $1,600 a month. I should have said $1,500 a month. The $1,500 a month is what he's paying back, and that's how we get to the $18,000 that we're paying back to ourselves inside the policy now. So you'll notice here in year 5, we have a negative 34,600 that's going back towards this policy. How that's happening is because number one, we took out our loan of $52,600. And this might even be helpful here. Let me just even pull up a calculator for us. So notice here on my little calculator, if I take my 52,600 and I subtract 18,000, that gives me 34,600. So you'll notice here that in year 5, if I take us back to this equipment financing example, you'll notice that in year 5, he's now just putting in, he's negative $34,600. And then every year after that, now he's paying himself an additional $1,500 a month or the $18,000 every single year over the next 4 years. Well, okay. Now 4 years went by. My truck wore out on me. I need to go and I need to go purchase another truck. So what do I do in year 9? I take out another loan. I call up the insurance company, say, hey, can I have 52 grand? They direct deposit it into my bank account. And now I take out another truck in year 9. What I do as well is I'm going to pay myself back the $1,500 every single month. Keep on going over the next 4 years until I paid myself back and extra interest. And again, the extra interest that we pay ourselves back is just more extra paid up edition premium that's going back inside of the policy. He keeps doing this year after year for the next 4 years until he reaches age 65. Because at age 65, I'm done. I don't want to keep doing this. I'm retiring. Well, we don't really believe in the word retirement over here, but we want to go do something different, and I don't need to keep financing these trucks for myself. What I want you to notice here that at age 65, if he just used this to finance a truck over the course of his lifetime through his trucking, or excuse me, through his policy, he would have at the age of 65 a $1,988,000 of cash value in here and a $3 million death benefit. If I compare this to the first illustration that we're noticing, I see right here by age 65, I had 1.5 of cash and a $2.4 million death benefit. So just simply by financing one truck using my banking system here, my cash value increased and so did my death benefit increase. And again, it just is because I'm putting in more paid up edition premium and I'm capitalizing this thing through myself rather than another financial institution. You'll ask yourself that, hey, I gotta go buy this crap anyways. So why don't I just use it out of my own general pool of money rather than going to somebody else asking to borrow from them because I failed on my ownership and commitment in my own personal monetary life to build a pool of capital for myself. So now I have to go and outsource it and I got to go and pay that premium price to somebody else. So if I were to just do it in here, I'm going to be so much better and farther out. You'll notice here now that his retirement income has also gone up. He's now taking out 125,000 a year rather than the 92 from our first illustration. And assuming that he has a death at age 85, he has now recovered 2 million of his cash value, plus he's able to deliver a $3 million death benefit. Because looky here. By age 65, because you'll notice in this column, this is our cumulative net outlay. This is how much monies and dollars that we put into the system thus far. He's put in a total of 315,000, yet he was able to take out 125,000 a year for the next 20 years of tax-free income. So he put in 315, he was able to take out 2 million, and he's also still able to deliver a $3 million death benefit to his beneficiaries. I don't know of a better system or place to warehouse my money that does this than my whole life policy. Because sure, could I do this with like a savings account or checking account at the local bank? Absolutely. But I don't get all of the dividends, tax-free component, the protection, the stronger interest rate. I'm not just withdrawing my money out. I'm taking out some policy loans. With all of those different benefits and the death benefit, I don't know of a better vehicle that has these features and benefits than what a life insurance policy does. Because, hey, let's move on. I just proved that if I just use this for one truck, I'm doing pretty all right. But I need more trucks because if I want to have a very successful business, I may want to expand my business, have more trucks to do logging with, maybe open up another location, and it will just allow me to have greater profits for myself and my family and my business. So, what if I want to finance two trucks using this system? He says, that's amazing. Can I finance two trucks through my bank? Assuming the same $52,600 financing package on each. Of course he can. So let's look at illustration number 3. Let's scroll down. And yes, I know these are very wonky illustrations that you see. Bear with me. If you have your book, Becoming Your Own Banker, you can see it right there on the page. So just bear with me. I'll send you guys cleaner images if y'all really want them. But what you really should do is you should have this book, Becoming Your Own Banker. So now, instead of just the one, we're going to finance two trucks using this system. I can do it because in year 4, I still have my 157,000 of cash that's in here, but now I'm going to finance two trucks using it. So let me do a new share with y'all. Let's go back to our calculator here. When I go back to my calculator, $52,600. Take it by two. That gives me $105,200 is what it's going to cost me to finance these. Now, if I go back to my illustration here, I'm going to do the same thing and I'm going to pay myself back and I'm going to charge myself interest again. So I call up to the insurance company. I say, hey, can I have a total of $105,200? They say, yes, sir, you can. We're going to directly deposit that into your bank account. I go out there. Now I purchase two trucks for myself. And now I'm going to follow the same rule. Instead of me paying myself back $1,500 a month, I'm going to double it. I'm going to pay myself back $3,000 a month, a total of $36,000 a year. So over the next 4 years, I pay myself back. Same way as if I were to go and pay back the commercial banks. I do it again in year 9. I need two more trucks, financing it through the cash value of my policy. I take out that loan and then I pay myself back $3,000 a month for the next 4 years. I rinse and repeat that process until I'm age 65. Now look here, look here. Age 65, I have a cash value of $2,459,000. Let's compare it to our illustration 2. If I just financed one truck, I had 1,988,000. Compare that 1.9 million to my 2.4 million when I just simply financed two trucks using the same system, same premiums going into it. It's a larger number because, again, money flows and grows to where it's respected, and I'm putting in those additional paid up addition premiums, thus allowing all of my money to continue to grow and compound in that uninterrupted compounding place. And that's how and why I'm able to see more and more growth in values, because I'm not neglecting the capitalization that's happening inside of this system. You'll also notice that my retirement income even goes up more. I'm now taking out $150,000 a year from this policy because, hey, look, you can control how much that you want to take out from your policy and live off of. You got 2.4 million here. Could I take out more monies if I wanted to? Absolutely. Could I have taken out less monies if I wanted to each year? Absolutely. But the main point I'm driving home is that this is done on a tax-free basis. And I'm not subject to those market fluctuations and taking out fees and all of the stupid bogusness of inflation, right? I'm doing this inside of a protected warehouse of my money. Now I'm just taking out 150,000 a year. He has now picked up an additional $471,000 by shopping at home for his truck financing. In addition, the retirement income from dividends has gone up to $150,000 per year, and the death benefit at this time is $3.9 million. So at age 85, $3.9 million I'm leaving to my beneficiaries versus a $3.1 million from the second illustration. He's even more amazed. And he asks, can I finance 3 trucks through this system? In this case, he's trying to do too much financing with too little capital. Here's what Nelson means by that. Let's get into illustration 4. So for 3 trucks, it's going to cost me $157,800. Well, I only have 157,363 as cash value in my policy. But I think you can go and find the additional $400 that you need to go and finance this truck, right? So let's just go with it. We're going to take out this full entire cash value here, and we are going to go and finance 3 different trucks now. And we're going to go and do the same thing. So now I'm going to pay myself back $1,500 a month times 3, which is $4,500 a month. Take that by the annual. $54,000 a year is going back inside of my policy. So that's how you can see right here. Each year we're paying ourselves back the $5,400 year after year. Year nine, my trucks wear out. I need to go purchase three more ones, and I take out another loan, finance it through this one policy here. I think you get the gist of what's going on now. So let's scroll down. Let's go to age 65 when we're looking to retire. Notice here, he's got 2.9 million of cash value that's sitting inside of this policy. He only put in 625,000. Look right here. He only put in 625 of outside of money, and he has 2.9 of cash value in here. Compare it to the previous illustration when we financed just two trucks. 2.4 million in cash value, comparing it to the 2.9 million. You didn't change anything that you were doing just besides financing an additional truck and then playing honest banker with yourself the same way as if you financed the first truck, the second truck, and then now the third truck. That's all you're doing. It's you and how you behave with this system. You'll notice as well, he has even more dividend income at retirement. It's up to $175,000 a year now that he can take out. Plus, he's got an additional 2.6 million in total income by the age of 85 right here, and still delivers a $5 million death benefit to his beneficiaries. Remember, the wisest thing he could do is add additional policies to his banking system as early as possible to enhance his ability to finance his entire inventory of equipment. This is just talking about the trucks. It's not talking about everything, but he can still improve on the results for the last example. Let's look at illustration number 5 now. When I scroll down and I look at illustration number 5, he's going to do the same exact thing of financing the 3 trucks. But what he's also going to do is he's also going to incorporate another truck and his insurance payments that he no longer has to finance through another outside company. You'll notice that all of these lines from illustration 5 to illustration 4 are the exact same until we get to year 13. Year 13, what I'm going to do is I'm going to start financing the insurance for all of these trucks. Because, yeah, he still has to go out. He still has to, by law, get liability insurance. But the collision insurance, he doesn't need to go and have that, and not required by law and state to have that. So instead of him going out to somebody else, he is going to go and finance these things through his policy now. Let's talk about it. The life insurance company's dividend scale did not change. They had nothing to do with this improvement. It was all on account of what the policy owner did. The gophers at the life insurance company made just as much money in the first illustration as they did in the last illustration. Nelson here is just talking about the dividends. See how the dividends improved? Let's just look here. Year 13. I'm at 18,000 in a dividend. Let's scroll all the way up. Let's compare it to like our first illustration. 11,000. Total dividend this year is 11,000. Comparing it to where I'm at now, 18,000 in year 13. And so he's saying, hey, nothing has changed in the dividend. Dividend scale didn't change. It's just how the policy owner is using it. In fact, the gophers cannot make a profit. They earn salaries and can earn bonuses if their efforts are superior, but only the policy owners can make money through improved dividends. I think that's an important thing to note because these are mutually owned insurance companies. And we, as policy owners, we share in the profits of that insurance company. And so who gets to reap all of the benefits of improved profits of these mutually owned life insurance companies is us, the owner. So note, can a truck be financed at this point? Absolutely. But he should continue to capitalize the policy for a total of 4 years. But anytime he can cut the bloodsuckers out of this pattern and have the same financial energy flowing through his banking system, he should do so. It should be obvious that this will improve all the cash value results below that point. If it isn't, then we need to go back and read this chapter over and over until it dawns on us. I want y'all now to really look at this, and I want to get deeper into this insurance if we just use it this way, because I kind of like how we get into this just a little bit, and Nelson does, because a lot of people will argue, well, hey, I don't need to have this because I can go out here and I can self-insure my stuff. Okay, well, first of all, that money is being leaked out to other people, not coming back to you and your family, but that's fine if you want to think that way. We are probably not a good match together. But what he's going to do is instead of him taking out these deductibles and having to pay a premium of $2,100 a year per truck, all he's going to do is he's going to use his cash values in here to do it instead. And he's going to pay premium into his policy that he would have paid to the other property and casualty insurance people. He's going to pay that premium now to himself. He puts $2,100 per year into the plan. The insurance company puts it to work in some sort of place that a life insurance company does, except they don't lend it to him. So they're just talking about the costs and the overhead fees of the property and casualty insurance company. That's not mutual, okay? They're going out there and they're investing their money into other avenues. And sometimes it's an if, well, I shouldn't say sometimes, it's always an if we need this collision coverage insurance. At this point, he should consider self-insuring for comprehensive and collision insurance. I did not say liability coverage, but he should pay his life insurance systems of policies at least the same thing he was paying to the casualty company. In this case, it should not be $2,100 per year per truck for a $1,000 deductible. It should be $2,500 per year per truck for a $0 deductible. You should pay yourself extra for this insurance coverage that you are now self-insuring for yourself using your whole life insurance policy. Now he is making what the finance company was making off him, plus what the casualty insurance company was making. And all of this is all done on a tax-free accumulation basis. I don't think there's anything cooler than this than having, let me just even say something. I didn't get it at first. Like I knew I grew up in a household where we didn't really go through insurance companies for health insurance and different things, you know? And a lot of this came because mom and dad were self-insuring us through the policies and the banking systems that they built. And to this day, you know, I don't know about y'all, but I don't use my health insurance. I don't need health insurance. Yeah, you're gonna need it when it effing sucks that one day that you actually do need it. But what I'm doing is I'm taking the precautions and the measures now to have that pool of money there. So when I do need it, I can dip into my own pool of money rather than having to rely on other people, pay that deductible out of pocket, and then having to fight with the insurance companies just to make sure that they do pay that claim, right? Because that's what happens. Not even talk about just the freedom and the liberty that you get to control everything that happens here and what you can use your money for. So I just think that's an important part to talk about. At this point, though, we should turn to the matter of the ownership of the policy. The company, a corporation, should not own it. He can improve the wealth building effects of the whole scenario by owning the policy himself, purchase the trucks himself, and then lease the trucks to his company or corporation. Now, I'm not a tax professional, I'm not here giving tax advice, but yes, I do agree that there can be some tax benefits playing the game this way. By doing it this way, he can have an interest deduction for the policy loans used to purchase the equipment because the loans are being used for a business purpose, and he can depreciate the trucks over a reasonable time. And he has a captive customer to lease the equipment to that is sure to make the lease payments, aka himself. I'll even argue, Nelson gets into this too here in just a little bit where he talks about, well, hey, I'm doing this all through myself in my trucks, but why don't I help other people finance their trucks? I can be the banker in their lives. They can put up that collateral of the truck with me, and then I can be the one to charge them this interest, and then they're the ones who are paying me the $1,500 a month. I mean, hey, that's what I do in my private lending business when it comes to real estate. Finally, let's take a look at illustration 1 and note the stream of the income of the 92,000 per year. So let's scroll up here. Illustration 1, we have our 92,000 per year. This income stream becomes income taxable when it exceeds the cost basis, which is 160,000. To go back to what I was saying earlier. Now go to illustration 5 and look at the stream of income of $225,000 a year. So let's go down right here. It too becomes taxable when it exceeds the cost basis. But look at the cost basis, line 36, column 7. Line 36, column 7, cumulative net outlay. You can see that it is now at 946,000. The difference between this number and the original 160,000 of capital is the interest he paid his policy during the entire period, and he gets it all back on a tax-free basis. Let's point it out one more time. If we finance all of these trucks through here, we paid ourselves a total of this 946. If we compare it to the first illustration of where we just put in 160,000 and that was it, he paid an additional, so the 946 subtracting the 160, he paid an additional almost 500,000 of extra interest to himself that went back into here, and it resulted in 3.5 million of cash value. Let's do this little math. I'm going to do this on the fly right now. So 3.5 million in cash value here. If I compare it to my first illustration, 1.5 million. So with the difference of an additional 500,000 of extra interest or paid up addition premium that he paid to himself, he just got back an additional $2 million of extra monies. Hell, I would put $500,000 into something if I had an additional $2 million of extra monies that I could use. Then, not to mention that I can now take this out and start living off of this money on a tax-free basis. Note, all interests involved in these illustrations have been paid by a withdrawal of additional dividend credits. Now, here's what I'll say. If your children really understand this concept, they will know that they don't want you to withdraw this money out. They know that they want you to keep taking out policy loans because it's just going to be better for them in the end and your entire family and the future generations to come. Because when you withdraw the money out, number one, you stop the compounding on the money. Then number two, you are also surrendering your death benefit. Because you'll notice right here in this illustration, the death benefit column, very far right-hand side, you'll notice that it kind of starts to go down. And then, yeah, it goes up just a little bit because dividends again, but then it keeps going down, 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 down. Well, dividends and then also our interest earned. But I will never have my parents take out withdrawals from their policies. I'm always going to make them take out policy loans because if my father or my mother comes to me and says, "Hey, we're going to start taking out withdrawals and not loans because they say maybe we're tired of paying the loan interest each year," I'm going to turn to them and say, "Well, mom and pops, I'll pay your loan interest each and every year. Allow me to cover that expense because I know it's just going to come back to me anyways in the form of a dividend." And then not to mention, my parents and I, we have a great relationship and they've been here for me. They have helped me finance things through my life as I get myself off the ground and start buying assets and investments for myself. I go finance things through the bank of Brent Kessler and the bank of Terry Kessler. I pay them my interest payments. We keep it in the family rather than me going down to another financing company and doing it. Lastly, there can be even further improvements in the performance of the system. Just consider that at age 66, he might sell all of his equipment to someone else just starting out in the logging business. This is kind of what I was saying earlier. And let's say that he wants to make a deal with this individual to finance all of his future needs for equipment when he has to replace each item. After all, he has over 3.5 million that is readily available to do so. In fact, he can make a very good living during retirement just leasing equipment to any number of businesses. Try this for exercise. So it's just taking it to the next level of you being the bank now. You be the bank in other people's lives. This is kind of where Nelson talks about in his grocery store example. You want to have multiple captive customers because the more customers that come in, it just means more revenues for you on your books. Yeah, you can have a profitable banking business when it's just you and your family being the sole consumers of your business, banking business. But when you start to allow other people to come in, borrow from you, yes, this is an investment. Yes, you should be putting up the precautions, have attorneys look at it, talk with your CPA about the tax advice there. But when you allow other people to come in and now borrow from you in your whole life policy, your banking system, you are now in control of that transaction in somebody else's life. And now you're making total impact and change on them. Because get this, this is kind of what I love about having the freedom to do what I want when I want. Because I can take my money, go give it to other folks, which is great. And I can be lenient with some of them. I mean, I've heard stories in the past where, let's say like I'm a landlord and somebody, let's say I have a widower that comes through and she really wants to rent out my place, but she can only afford 1,500 a month and my place is renting for 1,700 a month. Well, it's my freedom now that I can go in there and say, you know what? It's going to be okay. I want to help you. I will lease out this condo to you for 1,500 a month instead of my 1,700 a month because I want to help you get back up off your feet. And then from there, let's talk in 12 months. Maybe we renegotiate, we sign off on a new lease, and maybe then the rent prices will go back up to what they should be at the current market rate. So I'm not inclined to have to go through other people's rules. I am the one creating my own rules for myself over here. Does that make sense what I'm saying? You are now in total control of that banking function, and now you can go do whatever in the hell that you please with it. I hope this has been insightful for y'all, that I'm showing you that the more that you use your banking system to purchase the things that you're already going to buy in life, the larger these values do become. So, last thing I'm going to say in this chapter, because Nelson did pop in here after the initial publication of this book. A number of the people have expressed concerns that the figures used in the equipment financing are for the dividend scale of the year 2000 for that particular company. They are out of date. The dividend scales of most insurance companies are down and will diminish the results. Nelson responds, This is true, but I'm afraid that these folks have missed the main point of creating your own banking system. A system consists of many life insurance policies, and the number of years that each policy is capitalized must increase when the interest rates go down if you are going to expect similar results as those depicted. Let's just compare it to the bond market, for instance. In bonds, when interest rates go up, then the price of the bond goes down and vice versa. So, to generate a certain income from the bond, if the interest rates go down, I must pay more capital into this bond. If interest rates go up, then I don't have to pay as much money into the bond to generate the same income. And again, when we're comparing it to the bond rates, those are things that we cannot control with what the bond rates are doing. So look at illustration 6. Last illustration here. Look at illustration 6. When I ran the same policy but capitalized the policy for 5 years instead of 4 years, using a much more recent dividend scale with the same company, now compare the results with illustration number 2. Please notice that the results are considerably better. If the businessman now financed more of his equipment through his policy, reason and logic tells you that the results will be better than those depicted in the book, assuming that he paid his own banking system the interest rates as those he was paying the finance company. So let's compare it. This is illustration 6 here, putting in $40,000 a year over the next 5 years. So at age 65, he's got a cash value of 2 million. Let's just call it 2.2 million. He's got a cash value of 2.2 million, and he's put in 116,000 into the policy at this point. Now, if I go up to my second illustration here, go down to age 65, I now get a 1.9 million of cash value in the policy, comparing it to my last and final example over here of 2.2. So even me just financing an additional year of premium into this policy, I still come out on top, even on the more recent back then dividend scales. Because no, I mean, this book came out in this fifth edition is 2008 when it came out. And the dividend scale today is not the same as what it was in 2008. But that's not the point of what we're doing this with. So with this, he wanted to prove to us that the dividend scale has nothing to do when it comes to you behaving as you being your own banker. This is an exercise in imagination, reason, logic, and prophecy. None of the figures you're going to see are set in concrete. They will vary with interest rates and how you treat the system. Your behavior in managing the system is the most important factor in the entire equation. So please use your imagination. That's why Nelson dedicates a whole full chapter to imagination in his book here, Becoming Your Own Banker. So I know this was a lot of details here, and hopefully you can see what Nelson is talking about when we are taking out more and using more of this to finance and buy the things that we are already going to buy in life. But here he just labels it out specifically for my numbers people who need to see all the numbers. You can see right here that the more that I use my system, the higher the dollars are going to be and the more income I can use and live off of in my later years when I just want to chill. I don't want to be working as much as what I am now. So I hope this was insightful. I hope you learned something new. Please reach out if you have any questions. I'll be here. I'll be taking them. Send me an email to Hannah. Hannah spelled the same ways forwards and backwards. Hannah at themoneymultiplier.com. We can have a one-on-one conversation. Come and join me. We're traveling around the country. I know I have some virtual events that's coming up this month and even next month. And then We're going to be back on the road in 2025. A lot of exciting things happening. So I'll see you before Thanksgiving. In the meantime, I'm grateful for you. I appreciate all of you. And I hope that you can take and really learn from this and share this episode with y'all, your friends. You know, all those naysayers and the people who just don't quite get it. They're not riding the bicycle backwards quite yet. So thank you, y'all, for being here. I love y'all, and I will catch you next Tuesday. See everybody then.